So here we are, gold is falling, the euro is weakening, and the Canadian dollar is also joining the party on the downside, all while the US labor market just shrugged off geopolitical risks and inflation concerns in May, basically saying that we are fine, thanks. Well, the week ahead could become even more interesting with US CPI data due on Wednesday, and followed by the Bank of Canada's and ECB's rate decisions on Wednesday and Thursday, respectively. Investors are currently wondering whether the dollar strength is just a trend or the market is showing off after a strong payrolls report. So let's have a look at the technical signals and see whether that's the case. So having a look first at gold, well, we can clearly see a bearish breakout below the symbolic 200-day moving average, which actually helped the price to recoup some losses back in March. So the focus is back on the downside following this breakout, and the next support could be around the 4,200 level. Expectations for the US CPI, for the headline CPI, is for a faster increase to 4.2% year on year, compared to 3.8% previously, while the core measure could also move slightly higher to 2.9%. Both metrics are above the Fed's 2% target, and following a stronger than expected non-farm payrolls report, which showed triple-digit growth in employment. The data, well, an upside surprise in inflation numbers, could further pressure gold and strengthen the odds for a Fed rate hike in the year ahead. So in this case, we could see gold further weakening, and the break below the 4,200 level, where the support trend line from the lows of February 2025 is placed, could actually drive us even lower to 3,930 and 4,000 territory. Now, of course, while forecasts are comfortably higher from previous readings, so I would rule out a softer than expected growth in CPI data, and that could help gold to stabilize a bit, especially as the RSI and the stochastic oscillator are approaching oversold territory. So although the risk is to the downside, I would rule out a temporary upturn, and in this case, the 4,460 and 4,515 territory could act as resistance. This is where the 220-day moving averages are located. Then beyond that, the price may challenge this negative trajectory that started in mid-April, somewhere near 4,630 and 4,670, which also includes the 38.2% Fibonacci retracement of this down leg. Then beyond that, all the attention will of course turn to the 4,850 level, as there is a longer-term resistance trend line here, which coincides with the 50% Fibonacci mark. So a successful penetration higher here would actually eliminate concerns for a bearish continuation. And now looking at euro dollar, well, the ECB rate decision will come out on Thursday. Expectations are for a 25 basis point rate hike. This is well priced in, so the decision itself may not cause strong volatility if indeed policymakers deliver this increase in interest rates. However, what's going to be quite interesting is the press conference from President Christine Lagarde, as well as signals about whether policymakers will continue to increase interest rates, whether they're going to deliver back-to-back rate increases. So that's going to be a hawkish development for euro dollar. However, looking at economic conditions in the eurozone, well, growth is quite sluggish. It's faced a negative correction in the first quarter, and possibly that's a cautious signals for policymakers that could deter the central bank from signaling back-to-back rate increases. So again here, I believe that the risk is skewed to the downside, and if the 1.15 level fails to hold, the next support could come near 1.14 and 1.1440, where the price managed to pivot back in March. If that floor fails to hold, then the price would violate a long-term range territory, likely facing a steeper decline towards the 1.1275 region. Now, on the upside, if US CPI data arrive softer than expected and Fed rate hike expectations is perhaps the euro dollar could move up to 1.1625 and perhaps also meet the 1.1680 zone where this key constraining falling trend line is located. We need a clear break above this boundary in order to move higher towards the 1.1785 and 1.1825 region, which includes the 61.8% Fibonacci retracement of this downfall. This has been also a double top pattern back in April and May, so this territory is considered a significant resistance territory. And finally, looking at dollar loonie, which had an impressive performance lately. It's almost up by almost 3% since April's low of 1.3548, and we are currently testing the upper band of this broad range near 1.3945 and 1.3980, where the 38.2% Fibonacci retracement level of this downfall that started in January 2025 is located. Well, now as regards the Bank of Canada, while policymakers may refrain from raising interest rates, they will probably keep interest rates steady given the weakening economic growth. And although the jobs market surprised slightly to the upside last week, the unemployment rate is still relatively high. And there is uncertainty about the US and Canada's trade relations, so probably policymakers will probably hold their current policy stance, and that may provide some strength to the US dollar if US CPI data also surprise to the upside. So I would rule out further increases, but from a technical perspective, it seems that we are already within an overbought region between 1.3945 and 1.3980, according to the RSI, the stochastic oscillators. So I would rule out a pullback. Even not, if we see further increases, then all the attention will turn to the 1.4135 number, which coincides with a 50% Fibonacci mark of this downfall. It's the story will be all about the dollar strength here. Let's see whether the Bank of Canada could provide some direction about its future policy stance. According to futures markets, there's a probability for a single rate hike, but the odds are still low. So in the event that the central bank turns cautious, providing no clear direction, then that could help USDCAD to continue lower, to continue higher. Otherwise, if it sounds more hawkish, then the price may reverse lower to retest the 1.3790 territory, where the 20 and 200-day moving averages are located. Then below that, the turning points could be seen between 1.3730 and 1.3680. So we have cautious signals here, so keep a close eye on US CPI as well as on the Bank of Canada's rate decisions, while of course geopolitical risks might be also quite important for gold and the euro, which also faces risks from the ECB policy meeting. So that's everything I want to share with you guys. I hope you have an amazing trading session. We'll be back on Thursday for more technical updates. So that's a goodbye from me, and see you next time. Bye bye for now.